stop what you're doing right now and look at your screen. A silent alarm just sounded in the foundations of the global financial system, one so profound that its shockwave hasn't yet reached the headlines, but its tremor has just paralyzed the core of the world's oldest and largest physical silver market. In the last hour, without fanfare or official explanation, 3 of the most powerful bullion banks in the City of London, the absolute custodians of price discovery and liquidity for institutional silver, have simultaneously and indefinitely suspended their quotes. They are no longer making a market. The bid and the ask, the perpetual electronic heartbeat of the London silver market, has flatlined for key players. This isn't a glitch. It isn't volatility. This is a controlled, deliberate, and terrifying retreat by the very institutions that are the market. The phrase force majeure is being whispered on trading floors. The immediate question is, why? The real question is, what have they seen in the ledger, in the vaults, or in the regulatory horizon that we haven't? This isn't just about a metal. It is about the integrity of a pricing mechanism that underpins everything from industrial supply contracts to central bank balance sheets. The London exit is not a market event, it is a market admission. To comprehend the gravity of this suspension, one must first understand the sacred role these bullion banks play. London is not an exchange like New York's COMEX. It is an over-the-counter OTC market, a network of trust and colossal balance sheets. Here, giants like HSBC, JP Morgan Chase, and UBS don't just trade silver, they define it. They act as market makers, meaning they are legally obligated to provide continuous buy and sell prices to their clients, governments, mining companies, ETFs, jewelers, and other banks. They are the ultimate shock absorbers, using their own capital to warehouse risk and ensure liquidity flows even when panic stirs. Their quoted London Fix is the global benchmark used to price billions of dollars in physical metal, derivatives, and industrial contracts. When 3 of these pillars voluntarily step back from this fundamental obligation, they are not reacting to a storm. They are battening down the hatches because they see a financial tsunami on the horizon that their risk models cannot navigate. They are not merely exiting a trade, they are exiting their role as the linchpin of the system. This action screams that the perceived risks of continuing to make a market, the risk of being forced to deliver metal they cannot source, or the risk of holding a catastrophic price position, now outweigh the monumental profits and prestige of this business line. So, what catalyst could force such a synchronized retreat? The reasons are likely a confluence of 3 catastrophic pressures converging on a single point of failure. The first, and most immediate, is a total collapse in confidence regarding physical settlement. The bullion bank AAUS business model relies on a delicate dance. They take paper positions and hedge them with a complex web of physical metal leases, vault holdings, and futures contracts. They operate on the assumption that physical silver, while tight, can always be sourced at a price to meet delivery obligations. That assumption is now broken. Intelligence from refinery channels, mining output forecasts, and the frantic movements in Swiss and Asian vaults may have revealed an imminent, systemic shortfall. Perhaps a major sovereign buyer, a Middle Eastern wealth fund, or an Asian central bank has quietly called for the physical delivery of a gargantuan position held in London, a request that would drain the eligible vault inventory that underpins the entire paper edifice. The banks, realizing the metal simply isn't there to satisfy both this claim and their other obligations, have chosen to stop quoting rather than risk a default. They will not be the last holder of a paper promise with no metal behind it. The second pressure is a regulatory and capital reckoning that has turned silver from an asset into a liability. The implementation of Basel III and similar global banking accords has been a slow-moving train wreck for bullion banking. These rules require banks to hold significantly more capital against unallocated, precious metal positions, the very foundation of the London OTC market. What was once a capital-light, lucrative business has become capital-intensive and punitive. Holding large speculative books in silver now drags down a bank's crucial capital ratios, angering shareholders and limiting their ability to do more profitable business. Simultaneously, financial regulators, still haunted by the 2022 LME nickel crisis where a short squeeze broke the market, are likely conducting extreme stress tests and demanding impossible levels of liquidity proof for commodity books. A secretive directive from the Bank of England's Prudential Regulation Authority, or the U.S. Federal Reserve, demanding immediate collateral for silver exposures could have been the final straw. Faced with the choice of injecting billions in scarce capital to prop up a silver desk or simply shutting it down, the cold, algorithmic logic of the risk committee chose the latter. The suspension isn't a market play, it's a corporate survival tactic. The third and most sinister pressure is the fear of legal and reputational annihilation in a manipulated market. The bullion banking industry has weathered decades of allegations of price suppression and market cartels, often settling lawsuits for paltry sums relative to their profits. But the legal landscape is shifting. Aggressive litigation funds and sovereign entities are now armed with forensic blockchain-like analysis of vault movements and chat logs from past settlements. A major bank ICE internal audit may have uncovered a smoking gun, evidence of practices so blatant that continuing to operate the desk would expose the entire institution to prosecutions that could revoke its banking charter. Furthermore, in an era of weaponized finance, being a central node in the silver market is a geopolitical target. A nation-state subjected to sanctions could declare that its frozen assets include massive silver positions held in London, creating a legal nightmare for the custodian banks. Suspending quotes allows the bank's legal teams to assess a battlefield that has suddenly become existential. They are not just managing financial risk, they are managing extinction-level legal liability. The domino effect of this London exit will be fast, brutal, and global. The first casualty is price discovery itself. With the primary market makers gone, the quoted price of silver will fracture. The COMEX price in New York will become unmoored, trading in a vacuum of pure paper speculation, disconnected from the physical reality. What emerges will be a 2 or 3 or 10-tier market. The price for a 1,000-ounce institutional bar in Zurich will be one number. The price for immediate delivery of grain silver to a solar paste manufacturer in Frankfurt will be 50% higher. The price for a single coin from a dealer in Arizona will be untethered from anything but panic. This shatters global commerce. Industrial contracts with price clauses tied to the now-defunct London benchmark will plunge into legal chaos. Miners won't know what to sell their future production for. Solar companies cannot budget. The supply chain for thousands of essential technologies will seize up within weeks, awaiting a new pricing mechanism that does not yet exist. Secondly, a tsunami of capital will flood into the remaining physical avenues, causing a catastrophic demand shock. Every entity that thought it had exposure to silver through an ETF, a mining stock, or a bank certificate will realize their claim is now questionable. They will stampede into the only remaining outlets, physical bars and coins and vaults they can see and touch. This will instantly empty the inventories of major mints and refiners. Premiums will explode from a few percent to 100%, 200%, or more. The market will transition from how much does it cost to can you get it at all? This panic buying will further validate the bank's decision to exit, creating a self-fulfilling prophecy of illiquidity. Finally, this signals a terminal loss of faith in the Western financialized commodity system. London and New York have failed as the custodians of this critical market. Capital and metal will flee to perceived safer, or at least more transparent, harbors. Shanghai's gold and silver exchange, with its tighter physical delivery rules, will see its influence surge. Sovereign wealth funds will accelerate direct deals with mining nations, bypassing London entirely. The century-old hegemony of London OTC pricing will end not with a bang, but with a mute button pressed by its own creators. The suspension of quotes is the financial equivalent of the captains abandoning ship. They aren't telling us the ship is sinking. Their silent, hurried departure is the only message we need. In the end, the why is less important than the what now. The three banks didn't suspend quotes because silver is too volatile. They suspended quotes because the foundational myth of their market, that infinite paper claims can be seamlessly reconciled with finite physical metal, has been exposed as a myth at the worst possible moment. They have looked into the abyss of a true settlement crisis and chosen to step back from the edge. The tragedy for the rest of the world is that we are all still moving forward, unaware that the market's guiding lights have just been switched off. The London exit is not a problem to be solved. It is a new, terrifying reality to be navigated. In the silence they left behind, you can hear the sound of a global system reassessing what it truly means to hold an asset, and the frantic, scrambling beginning of a new order where paper promises are no longer welcome, and only the tangible will survive.